Welcome to The Explainer. Today, we're going to tackle a question that so many of us have. You've got some money you want to save every month, which is awesome, but what's the smartest thing to do with it? Well, we're going to break down two of the most popular choices out there, SIPs and RDs.
All right, let's just dive right in. We're going to start with a puzzle that, a lot of us face every single month. And hey, it's a good puzzle to have, but it's still a puzzle.
So, you've done the hard part. You've carved out a piece of your income to save. That's the biggest step for sure. But then comes the big question, where does it go? It can feel a little paralyzing, right? Do you play it safe or do you shoot for bigger growth?
To help you solve this puzzle, we're going to explore two really solid options. Now, both of them are built for that regular, disciplined saving habit. But you're about to see they take you down very, very different roads.
So let's get properly introduced to our two main contenders. Because really, once you understand what makes each of them tick, you'll be in a much better spot to figure out which one clicks with you.
First up, we've got the Systematic Investment Plan, or what you'll probably hear called a SIP. The best way to think about a SIP is it's like putting your investing on autopilot. You pick a set amount of money, and every month it automatically goes into a mutual fund. This way, you're buying little pieces of the market over time, which is a really smart way to average out your costs and smooth out the bumps of a volatile market.
And then on the other side, we've got the recurring deposit, or RD. Now, this is more like a super structured savings plan you set up with your bank. You agree to put in a fixed amount every month for a set amount of time, and in exchange, they give you a guaranteed interest rate. No guesswork, no surprises. It's all about rock-solid predictability and safety. Okay, so we know who the players are, but how do they actually stack up against each other? Let's put them head-to-head and look at the things that really matter.
All right, you're going to want to pause here because this chart, this tells the whole story. Just look at that top row. With a SIP, you're embracing market risk for a shot at much higher returns. With an RD, you're getting total safety, but the returns are more modest. It's the classic risk versus reward trade-off. And as you go down the list, you see other differences pop up. SIPs tend to be more flexible and can be more tax-friendly, while RDs are simpler but a bit more rigid. Let's just zoom in on the returns for a second. With a recurring deposit, you are living in the zone of certainty. The bank tells you upfront, this is your interest rate, and that's exactly what you'll get. The stock market could be on a wild roller coaster ride. It doesn't matter one bit for your RD. It's predictable.
And then you have the other side of the coin. With a SIP, you're trading that certainty for potential. Now, are these numbers guaranteed? Nope, absolutely not. They're based on historical performance. But this is where the power of compounding, that snowball effect for your money, can really kick in over the long haul, leading to some serious growth.
So after seeing that comparison, you can probably already feel yourself leaning one way or the other, right? It really comes down to your personality as an investor. The real question is, which one of these profiles sounds more like you?
Let's see. If you're looking at this list and you're just nodding your head thinking, yep, that's me, then an RD could be your perfect match. Maybe you're saving for a down payment in 2 years or a big trip next summer. You need that money to be there, no questions asked. An RD gives you that secure, predictable path.
But what if that last slide didn't sound like you at all? If you're thinking bigger picture, things that are way down the road, like retirement, and you've got the stomach for the market's natural ups and downs, well, that's where a SIP really gets a chance to shine. The key ingredient is just giving your money enough time to grow. And all this brings us to what is honestly the most important takeaway from our whole conversation today. The goal isn't to figure out which of these is better in general. That's just the wrong question. The only question that matters is which one is better for you. You got to take a moment and think about your own needs, your timeline, and be really honest about how you feel about risk. Because at the end of the day, there's no magic answer for everyone. The best strategy is always going to be the one that helps you sleep at night while getting you closer to where you want to be. Look, our whole goal today was just to cut through the confusion and give you some real clarity on these two powerful tools. Maybe you'll choose the steady path of an RD. Maybe you'll go for the growth potential of a SIP. Hey, you could even do a combination of both. The important thing is that now you have a framework to help you confidently take that next step on your own investment journey.